The National Stock Exchange operates as a pure order-driven market. There are no designated market makers assigned to quote prices or absorb excess inventory. Every transaction is matched electronically, driven entirely by the participant order book. The baseline assumption of the efficient market hypothesis states that these limit order books should exhibit weak form efficiency. Future price movements should follow a random walk, with current prices accurately reflecting all historical trading data. Empirical data from the Nifty 50 contradicts this assumption. The index displays highly predictable calendar anomalies and intraday liquidity bottlenecks that repeat with statistical regularity. Our objective is to design a multi-layered systematic trading architecture calibrated to exploit these rigid inefficiencies. Executing this requires tracking three distinct variables: macroeconomic capital flows to determine market direction, temporal variance to time our exposures, and dynamic futures and options logic to manage execution. Assuming the National Stock Exchange is perfectly efficient results in negative expected value. Abandoning that assumption is the mandatory first step to generating systematic alpha in emerging markets. The foundational layer of this architecture establishes the market's macroeconomic flow regime. We cannot deploy risk without measuring the capital pushing the index. Foreign institutional investors, or FIIs, inject massive capital into the Indian equity market. These flows are highly sensitive to global macroeconomic indicators, particularly the supply and strength of the US dollar. A high supply of weak dollars pushes foreign capital toward emerging markets in search of yield. This influx drives short-term directional sentiment and disproportionately impacts the large-cap constituents of the Nifty 50. The counterweight to this foreign influence is domestic capital, tracked as Domestic Institutional Investor, or DII, flows. DII capital is largely comprised of domestic mutual funds, pension schemes, and insurance companies. Crucially, this pool is fed by a surging baseline of retail systematic investment plans, injecting billions of rupees into the market on a rigid monthly schedule. This creates a localized, continuous capital stream that acts as a structural volatility absorber. When FAIs aggressively liquidate their positions, consistent DII purchasing softens the index decline. Analyzing the net divergence between FAI outflows and DII inflows provides a precise metric for market resilience. Calculating this ratio is the required prerequisite filter before assigning directional risk. Once the macro capital direction is established, the secondary layer determines exactly when that risk should be sized up or down. We do this by mapping the index's calendar seasonality. This chart visualizes a Garch 1-1 econometric model, tracking the distribution of returns and volatility across the 5 trading days of the Nifty 50. Focusing on the Monday data, the model reveals a positive alpha 1 coefficient. This indicates statistically significant elevated average returns occurring simultaneously with elevated volatility. Monday is a structural high-risk, high-return environment. The fact that historical data can reliably predict higher Monday returns is a direct violation of weak-form market efficiency. Moving to Tuesday, the data flips. The model yields a negative beta 1 coefficient. The data confirms with statistical certainty that Tuesday returns are systematically lower and experience tighter volatility than the Monday baseline. Additional anomalies appear later in the week, specifically negative returns on Thursdays and Fridays, but econometric analysis shows these primarily impact small and mid-cap indices. For the large-cap Nifty 50, Monday and Tuesday are the primary operational nodes. Maintaining static risk exposure evenly across the trading week guarantees capital drag. The architecture requires algorithmic position sizing, scaling risk up on Mondays to capture the volatility premium and reducing it on Tuesdays. Daily seasonality dictates the risk weighting, but we have to drill down into the intraday market microstructure to actually execute the trades without severe slippage. Limit order execution relies on 3 core components of liquidity: depth to absorb large orders, a tight bid-ask spread to minimize transaction costs, and resilience to bounce back from price shocks. In a friction-free limit order book, an increase in trading volume brings a denser concentration of orders. This naturally compresses the bid-ask spread. This scatterplot maps actual intraday liquidity on the Nifty 50, utilizing research from Monash University. The data plots a distinct U-shape, revealing a severe paradox. The highest trading volume of the day occurs directly at the 9:15 open and the 3:30 close, but these periods also exhibit the widest bid-ask spreads. Concurrent high volume and wide spreads are standard in quote-driven markets, where a monopolistic market maker widens the spread to manage their own inventory risk at the open and close. Finding this behavior in a pure order-driven market like the NSE indicates severe transient liquidity inelasticity. Intraday liquidity on the NSE is a time-bound trap. Standard market execution at the open and close is mathematically inefficient, incurring maximal slippage costs. We have mapped the capital flows, the calendar anomalies, and the intraday liquidity bottlenecks. The final layer applies derivative execution logic to extract profit from these constraints. Static hedging fails in this environment. Blindly purchasing protecting productive is cost inefficient because high volatility inflates premiums, draining capital over time. Instead, the architecture deploys dynamic strategies. To exploit the Monday anomaly, the system uses gamma scalping. This option's payoff graph illustrates the mechanics. By purchasing at the money straddles, the model aggressively captures the high Garch volatility and the U-curve spread spike triggered at the Monday open. The system continuously adjusts the position's delta back to neutral using futures contracts. This monetizes the rapid intraday price shocks generated by the liquidity inelasticity, converting the volatility itself into an income source. For Tuesday, the execution logic inverts to match the data. The model deploys calendar spreads. By shorting near-term options, the system aggressively captures theta, or time decay, maximizing profit during Tuesday's proven volatility crush. The second leg of the calendar spread, the longer-dated option, is maintained to ensure continuous portfolio insurance against sudden macro-level FII tail risk events. To bypass the unpredictability of directional movement entirely, the architecture can deploy vega-neutral straddles across different expirations, immunizing the portfolio against implied volatility distortion. Derivatives are not used here as speculative instruments. They are precise mathematical tools applied to physically extract the proven temporal and liquidity anomalies of the index. This blueprint maps the complete three-tier architecture. It isolates a capital flowing into the system, sizes risk according to measured calendar anomalies, and dictates precise execution based on intraday liquidity curves. Treating the National Stock Exchange as a frictionless, efficient environment guarantees systemic failure. The data proves the friction exists. A true mathematical edge requires combining macroeconomic divergence, calendar predictability, and dynamic options logic into a single operational framework. In structurally volatile emerging markets, advanced risk management serves as the primary mechanism for capturing alpha.